Hey, welcome everybody to the 40 Finance channel. Today I'm just doing a quick live stream. I want to share with you the sort of rabbit hole that I went down last night as I was looking at shares outstanding and how they're trending over time for some popular stocks. So I've got 10 stocks in total today, cherry-picked them all as I was just looking up the information, but stocks that have shares outstanding increasing, and then another 5, which is the 5 we'll start with, that actually have decreasing shares outstanding. And the reason this is important, it's not a huge indicator, but obviously we talk a lot about buybacks and things like that, and what goes into it, and particularly in time when we're seeing slowing growth. Depending on what you buy in on the inflation story and the consumer story. But long story short, if you will, the shares outstanding as they decrease for a stock, when a stock's doing buybacks and whatnot, there's a certain level where it does start to become a tailwind for investors. And there's no better case than that than Apple stock, which is arguably the leader in stock buybacks, certainly out of the mega cap companies that are out there. So I'm just going to share with you some of the research that I've been doing in the background, just kind of having fun with it and eyeballing a few names, and hopefully it leads you to your own thought process, and maybe you want to carry on where I leave off here today. So hope everybody's doing well. H. Montero, Black Andrew, good to see you guys. And let's jump in with what I would consider to be sort of the gold standard of stock buybacks, and that would be Apple. And this site here, Macro Trends, it does a good job of like high level of shares outstanding, so we're going to use that, but I'm going to show you a better way, or I would say a more detailed way with SeekingAlpha here in a little bit too. But just to plow through the names and keep it interesting, we'll stick on macro trends. And here we have Apple shares outstanding through the last 11 years or so. And I kind of like the numerical, but they got a really cool graph here, and you can see what Apple's done over the last several years. And if we highlight it to a 5-year look, it's even still substantial from a bar chart or bar graph perspective. But the numbers to me tell a little bit better story because you get that sort of percentage in there. And we see that, in 2021, they took 3.5% out of the shares outstanding, did about the same in 21. In 20, you actually had a over 5% decline from 19 into 20. And the year before that, 7% decline. So I'm not sure if you can just add these up. I don't know if you get the same calculation. But basically, since 19, at the end of 19, you were at 18.59 billion shares. And then at the close of 21, they basically took 2 billion shares off of the table. So that's a pretty impressive run for Apple. And as I said, you can see it demonstrated here in this 5-year chart. So they are far and away the number one company, number one mega cap stock that does these buybacks. Now, the next one I have is Target. Stock I don't really talk about too much, but I shop there all the time. And here's Target, 2021, at least through October. They brought theirs down 3%, year before that 2%, and then the prior year's 3%. I thought this year, this was an interesting line from 20 into 21 and 19 into 20 just because of the impact of COVID. It's kind of surprising to me anyway that they were running retail stores and still buying back, but it was a strong move. And if we do a 5-year, you can see that Target has done very well in lowering their pool, at least from this bar chart perspective. So Target is one to add to your list to look into. Then we have Visa, which is a stock that I own. Here's Visa's 5-year. Looks really good. And they did past few years 1.7% decline last year, 1.5% before that, 2% prior to the pandemic. And don't forget, Visa also had some revenue challenges with the pandemic. Frankly, they're still going on in terms of cross-border travel, business travel, etc. And yet they continue to prioritize this. So 2019, you had 2.52 billion, and now you're about down to 2.4. By the way, I forgot to mention, for all these top five, so we had Apple, Target, Visa, and we got a couple more. They're all continuing the program. So that's why I cherry picked these guys. And the next one is Google. These are all companies that have not only done it in the past, but they're prepared, or at least in their headlines, they say that they're going to continue. So Google here, 1.3, not as strong as the other ones, but I will say that Google comes in a very close, well, not very close, a second place, if you will, to the mega cap names. So Microsoft, for example, was under 1% in each of the years that I looked. As far as declines or increases. Google, I mean, they've at least established a pattern here, dating all the way back to 2019 or so. If we, it's interesting on their bar chart that this is the total. If we go back to up through, looks like 12/31/13, so through fiscal year 2013, and even beyond, actually, now that I look at it, they were actually adding shares. So if I had to guess, just by eyeballing the chart, they didn't start pulling back until around 2019 or so, which you can see by this little red line. I guess it was the end of 2018. But we stack it on a 5-year, and how about a 3-year just for fun? Now you can see how it's escalated over the past 3 years, which is, hey Dave, how you doing? 3 years, they've definitely prioritized it more. Where this red gets a little bit deeper is actually a good thing if you're interested in decreasing shares outstanding. So that's Google, that was number 4. And the 5th one I have is not as big, but they just had a huge announcement, and that's Berkshire. So 2021, Berkshire, 5%, which actually tops Apple. Now, they don't have nearly as many shares as Apple. And then in 2020, they did 2.4%. And the years prior to that was pretty much nominal. If we throw up the 5-year, it's really hard to see much. There was an event, some sort of event happened here. I don't know what that was. I didn't read into it. But if you get into the 3-year, or AKA kind of the pandemic period, you can see how this has increased. So it's interesting. You know, you're getting a lot of Warren Buffett call-outs these days as value has returned, so to speak. And look what he's doing, right? So not much of a growth stock guy, so he's finding other ways to add value. Very interesting. This is Berkshire B. By the way, this is not the A shares, which are fun to look at the A shares, but frankly, they're out of reach for, they're certainly for me, and I would imagine most of the people who watch, YouTube stock shows, they're not buying A shares. Okay, so that was our top 5 who are buying back shares that I could find that also have a continuing program at least through 2022. So again, I'm sure there's dozens more, but I literally have to do research comparing, multiple things. So those are the ones that I picked out. Now, on the negative side, and not even negative, I'll just say on the shares increasing. First up is Tesla, out of the big names. And you can see that Tesla last year, 2021, they had a 4% increase in shares. The year before that, about the same. And then in 2020, they increased 22%. And I think that was pretty well documented, that during COVID, they added more shares at the real height of their popularity from the sort of meme stock world, if you will. And if we look at the 3-year chart, pre-COVID, that comes in 1/119. You were at 0.8 billion, and now you're at 0.12 billion. And you can see that mostly increased in the 2020 fiscal year. All right, next up we have Square, which is a stock I own for better or for worse. Square increased 3% last year, 3% in 2020. 2019, they threw 15% more shares on the market, and 7% in 2017. So I've been doing a lot of 3 years. We'll stick with it. This is 2018. You can see through the pandemic, total number, I don't think is, 0.4 billion, and you're going to land about 0.5 billion here. But it is interesting that Square is adding more. So that's just a quick look there. Number 3 is a stock that I've been looking at because I'm in the middle of youth baseball season, and I feel like I spend a ton of money at Dick's Sporting Goods. So I knew that they went through a pandemic boom, and frankly, I see like youth sports and that kind of thing continuing on. They also have camping, and some of those concepts, but holy cow, in 2021, 17% more shares on the market, and in 20, let's see, I don't know what the difference is here because we have 2 lines of 2021. Let's just stick with the 17%. Then in 2020, they added almost 10%, and the same thing in 19. So what's interesting is look at this chart. Now this is the all. Okay, so this goes back to 2009. So they started up here at 0.12 billion, and they had it down to 0.08 billion, and now you're heading into 0.12 again. I'm guessing that they took advantage of the COVID run on their stock, which the stock did go up quite a bit because they had some great sales quarters, particularly on e-commerce, and they took advantage of that, right? And they issued more shares. I guess what's important is, when does it stop? And for that, you'd have to research more about Dick's. I know that as somebody who was considering maybe Dick's as a offset to some high growth tech names, this chart doesn't do a lot for me as far as a vote of confidence. But just to be fair, there's more than shares outstanding to look at with the stock. Obviously, we'll talk about that in a second. Next up, Carnival. So we have travel increasing, right? Is Carnival finally going to get out of the COVID pandemic limitations? Well, even if they do, they added 44% more shares last year. Okay, and in 2020 they added 12%. That's prior to a 2.5% pre-COVID times. And you can see on this all chart, which CCL has been around for a long time, they were kind of just riding along, if not declining shares heading into COVID. Now we understand, of course, that their business was put at major risk. And they took advantage, I shouldn't say they took advantage of it, I should say one of the ways they dealt with it was to really pump shares. And by really, I mean a lot. So if you are a long-time CCL stockholder back in this period, and you were hoping and you hung on and you said, gee whiz, they'll bounce back eventually, certainly what you didn't account for was a, 50-60% increase in shares. That's a tough one for CCL. Of course, if you bought in today and you went by the EPS projections today, those would already be accounted for. It's just hard to say when do they stop throwing more shares on the market. All right, next up is Shopify, which I was a little surprised here. And it's not terrible, but this is a company that is throwing some more shares on in good times, I would say. So 3% increase in actually it's right here, 3% increase in 2021. During the pandemic boom, they took that opportunity to raise more money and they threw 10%-ish more shares on the market. Then you had 7% additions even before COVID. And, you know, so I guess what I would say with Shopify is there is a grain of salt here because the company is growing and their EPS is growing faster than the shares that they're adding. And that's one of the, you know, big topics, particularly if you think about Tesla. You know, they do have a growing EPS, but if we just go on 3 years, looks like they've slowed down here some, just getting into maybe the 2 or 3% range. But again, if you bought into this company prior to COVID, you're doing great, but the number of shares out there was 0.1 billion in 2018, and now you're approaching, you know, 0.13 billion, so you've been diluted just a little bit. All right, so those are my 10. Now very quickly, and then we'll get into, Andrew's talking about Palantir. That's a good call. Palantir's chart might be weird because of the fact that they're sort of IPO'd, but here we go. 2021, shares were up 117%, and in 2020, they were up 70%. Now, I can't remember for the life of me when Palantir came on the market. This chart is saying June of 2020. I don't know if that's true, but let's just pretend it is. So if this is when they premiered, let me do this. Let's just look at Yahoo real quick, see how far their chart goes. Saying October of 2020 on Yahoo, just as a quick guess. So that makes it it's hard to tell what that is, but let's just go here. 0.9 billion, now you're up to 1.9 billion. So obviously huge, and this huge increase that we see here, plus 206%, to Andrew's point, that is well after whatever IPO date I couldn't find was, right? Because that was in October. Of the worst case scenario, they came on the market in October of 2020, so certainly in March, they dumped a bunch of shares on the world, and similarly there in June. So big increase by Palantir, and I've talked about that, and the Palantir is the stock I own, honestly, and it's it'll be interesting to see how they deal with this, considering that they do a lot of stock-based compensation to hire developers and such. You know, how will they look at that in the future? It's hard to tell. We'll just have to see how it goes. I look at Palantir in my personal portfolio as it's a long duration asset, I guess you would say. I don't have any dreams that Palantir is going to make me rich. I do love what they're doing in technology, and I do love that they've gotten out of the government sector. And even with the share count, which is obviously a huge negative, I do expect their EPS to be growing. So in comparison to something like Tesla, who is growing EPS out the wazoo nowadays, you can stomach some of this if your EPS, this is Tesla by the way, if the EPS is growing faster than the share count. And that was a point that I was going to cover here at the end, is some of these growth stocks, not a big deal. Now you get into, do I have a good, how about, well, we talked about Dix and CCL, right? So with Dix, in comparison to Palantir and Tesla, if this was normal times, which it was back in 2016, they were declining share count. They had a COVID boom what does the future hold? Does COVID going away and the e-commerce increase their competition? So that's where this one gets a little weirder compared to Palantir and Tesla, who are, I'm not going to say guaranteed compounding earnings, but it certainly looks positive. Dick's, I would argue, is at a crossroads. Does their business continue to perform well? Did they make fundamental changes to the business that are going to last for years and years? I don't know, but it's too much of a crossroads for me. All right. So I did want to show you something on SeekingAlpha. You guys know that that's pretty much my number one affiliate program that I work with. So if you've bought into it, I wanted to show you where to find this on SeekingAlpha. Let's start from the top. By the way, if you haven't joined SeekingAlpha, my affiliate link's in the description. You save, it's over $100 on a 1-year subscription. So definitely check that out if you're interested. And I should have been talking through the clicks here. So if we land on the Apple page, we're on Summary. And if you're playing at home, you go to Financials. Then they have these financial statements. They go, I don't really like that it goes left to right. I guess it makes sense that you read that way. But just know that this is 2012 and this is 21. Then you go down here to some of the per share items, right? Supplemental items. So you have basic EPS to give you a quick bar chart. This is over time since 2012. And then you have basic weighted shares outstanding, which obviously balances. We're looking at an annual view, so this is a good way to look at it. And you can see how Apple's has declined. But basic EPS is going up, right? So right off the bat, if somebody just said, quick look at this company, here's what we got. We have shares outstanding going down. We have EPS going up. That's not the end of your research, but that's a very positive sign. And the more and more I look at it in Apple's world, the more I understand how a company that basically does, single digit revenue and EPS growth, this is how they pull it off on the shareholder value and the returns, right? And even if you go to diluted, which many would argue is the better way to view, then you've got the same, that's continuing operations, but you got basically the same EPS, and even the diluted shares outstanding are right there. And if you're more of a numbers guy, sometimes I like to look at the real numbers. It just translates better in my head. You've got them all right here. Okay, so those are obviously in the millions. But you can see, since 2012, is that what it is? Yeah, 2012, 26.4 billion shares, and they've taken 10 billion of them off the market. That's pretty, I don't know, it's pretty impressive. But again, Apple, to me, it's the gold standard. Let me pick another positive one. Let's just look at Target. I think Target is an interesting company. As a potential play during, if you're getting, let's just say, nervous about inflation and whatnot, because they're just going to pad their revenues during that, would be my 2 cents. Let's go to their diluted EPS. Okay, minus something happened here. I don't know what that is. I don't know their whole story, but you got diluted EPS going up over time, positive. And you have shares outstanding, not as impressive as Apple, but going down over time. And then you have the raw numbers here. So that's good. Now, let me see who was on the negative side. How about CCL? And by the way, can I tell you one thing that's a huge time saver on SeekingAlpha that I want to thank their developers for? If you're on like this weird, secondary page of financials and financial statements, if you type in another stock, so we're going to go CCL, it takes you to that same view. So it doesn't take you to like the summary page. It's so nice when you're just plowing through comparisons. Okay, so staying on topic, supplemental items, basic EPS, diluted EPS. So here's the inverse, right? Here's what I would say would be a red flag if this was the only thing you looked at in your stock research. Hey, I got this company, their EPS is down, right? Pretty significantly over the past 2 years, and their shares outstanding have jumped over those past 2 years, right? So that's really what this exercise is. It's again, we know the story on CCL. There is some ambiguity in there. We don't know when the world returns to normal. We know why they issued more shares, but for the purposes of this video, that's why I was showing you guys these things, because if anything else, it's interesting and it's worth a look. So I'll just leave it at that. H Montero, I thought it said, I hate SeekingAlpha. It's I have SeekingAlpha and love it. Yeah, I honestly, it's been, I like Yahoo Finance because I think that Yahoo Finance is a little bit more colorful and shiny. But if you're a numbers person, it's really hard to beat this one. The one thing that Yahoo Finance beats SeekingAlpha every time is past. Looking at the past. SeekingAlpha doesn't cover the past much. Like, we have these financial docs that come in, but they don't really give like a ton of historical looks outside of these bar charts and this sort of whatever you want to call it, number table. You know, some people can't even handle this because they'd have to think for themselves. I don't mind it, but it's going to be off-putting to some people who need all the pictures drawn up for them. Great Stock Vortex is here, and talking about Starbucks, let's just do Starbucks. I didn't not look at their buyback program or anything. And again, it's not everything, but let's just see what they're doing. All right, diluted EPS. Making a good comeback. We know what 2020 was. We know what the problem was there. And I would say, just looking at this one little bar chart, October of 2021, they're above 2019 relatively substantially. And it looks like 2018 was a hell of a year, and they're beating that one. 324 up to 354, and that's in the books. Right? So these are not projections. This is in the book, so definitely strong. And then shares outstanding, not too bad. Looks like they did do maybe a minor bump in 2020, but like super minor. But it is going down from 2019, looks like. So yeah, just to stay on topic with this particular video, you know, those two metrics for Starbucks look good. Out of curiosity, since we're here, let's see what people are picking for Starbucks. This year, EPS of 334 if the projections hold true, 3%. And then next year, 391. Yeah, double digits. And you know what? These 22 earnings per share, and I'm not just talking about Starbucks here. I think that for all of us, you have to pick a side. You guys know that I'm buying into the Qs. I'm not necessarily like mega bullish guy, but I will continue to buy in this downturn because I do believe the second half of the year gets better, and certainly into 2023. And I'm a long-term investor. Right? So I'm taking advantage of the companies that I like, but in particular, the Qs, just to not have the pressure of picking one or two stocks in this environment where there's a lot of things on sale. My point was, though, these 2022 estimates, I think that analysts are getting very bearish. All right, because of the pressure that's on the economy. And it wouldn't surprise me whether it's Starbucks or Target or whoever the hell it is we're looking at today. If that's a strong company, I think they will outperform almost every estimate that's out there right now. And conversely, I think that as we get into summer, these are estimates, right? You will start to see these go up. So it's good to take the estimate and project the future, at least in terms of what you're going to pay for the stock. But I think you also have to pick a side. Are you perma-bear? Is it World War III and 50% inflation? Then I understand why you're not buying. But if you're not buying into that story, as basically where I sit, then you have to start thinking outside the box, because analysts are just covering their butts right now with low ball estimates, in my opinion. Looking at Starbucks, I mean, look at this revenue growth for Starbucks, double digits, and basically knocking on the door of double digits for the next few years. So I got to say, for Great Stock Vortex, throwing this name in, I mean, it's a good looking name, just on the fundamentals here. That PE, it says 24.75. Where are we at today? I don't know what today's is. I guess it doesn't matter, because I always look forward too. So good stuff. While I'm here, if there's any stocks you guys want me to look up real quick on the same topic of shares outstanding, I'm happy to do it. I'm just flipping over to the live look. And, you know, what a day for the NASDAQ. And I, unfortunately, have a lot of stuff going on today, so I can't just stare at it. But I think we let off today. Yeah, that's what I was looking for. Yeah, it got to 12.9. Now you're down to 12.6. Like, what a wacky, wacky day. We actually started off a little soft, and you saw how it went up. I have not had the time to look at the news. I know that China has an outbreak for coronavirus. That doesn't really shake me up too much. And then obviously we have Russia, Ukraine as well. Let me see if there's any war updates here. Been going to AP News lately. I don't know about you guys. Not because it's, you know, world-class coverage. I would say it's good coverage. I'm so tired of CNN versus Fox on, like, you know, we have to set things up so our Democratic readers like it, and we got to set things up for the Republican. It's stupid. I don't see any groundbreakers here. Russia keeps up attacks. And of course, they're talking about World War III. McDonald's pulling out of Russia. That's kind of older news, but I did think that that was surprising. And I think McDonald's is a halfway decent economic downturn play. Oh, for Christ's sake, MCD. But I got to wonder what happens, how much business was in Russia. I'm sure it's not good, because usually those foreign markets do pretty well with just the American branding. I don't see a huge drop-off here since they've announced that. In fact, arguably, if this was March 10th and they announced it, they went up a little bit. So, you know, whatever. But it's gotta lean on the EPS a little bit, I would imagine. Let's see what we got for this year. $10 or so, almost double digits. Next year, about the same. Revenue, I mean, this is a huge company, right? $25 billion. So to eke out 6% on it, and to even be growing, is substantial. So I don't know. They have a dividend. It's probably one of the reasons that I won't buy into it, not because I don't like dividends, but just because in the account I share with you guys, that's a taxable account, so I'm not really prioritizing dividends. But that would certainly be part of, you know, the total return that you would get at the end of the year. All right, Montero throws out Big Five Sporting Goods. Is that what that one is? Okay. We'll get some weird... Is that IPO? No. Been around for a while. Okay. I've seen this one. You got this. This is an algorithm. So it says, you know, if you're in SeekingAlpha, Big Five, high risk of cutting its dividend. That is not That's not a human being who says that. Okay, so that's an algorithm. I have no idea if it's true or not, and I'm not going to go there. But let's take a look at what we started with on the show today. Go down to our supplementals. Let's get to diluted EPS. Headed in the right direction. Relatively strong direction coming out of 2018. Pre-COVID, you had 40 cents, and now you're really rocking 4.55, and that's in the books because it's January 2022. Shares outstanding, essentially flat. The low bar was 21 million in 2018, and you're at 22.5 million. So they've added 1.5 million shares, but that's not the end of the world if this keeps up. Certainly not the end of the world if this keeps up. But you might have to factor in maybe a couple percentage points off of EPS projections if they keep doing it. Let's see what the estimates are. Not a lot of coverage, unfortunately, just one analyst here. So you just have to read into where the next, so if you get this, by the way, where you're looking at a stock, and this is obviously a smaller cap name, what's your market cap? $300 million. If you get in these situations where you're like, geez, no analysts, I don't know what to do. Honestly, the best place to do is to go back to their earnings reports, right? And SeekingAlpha makes that very easy. You go to earnings, then you go to transcripts. Hopefully they have it. And they book all these transcripts. They save them for everything. So let me see. How about... So this is transcript of the earnings call, which is great. I want to see this to save time on this show and just look at the press release. Declares... So this is funny. Bullet point number 4. Let me check the date on this. Okay, March 1st. Declares regularly quarterly cash dividend of 25 cents a share. So I guess the algorithm was wrong on that thing. Let me see if they can give us guidance, because we know there was only one analyst, and that's what I was trying to tell you. First quarter guidance. For first quarter, same store sales to decrease 10 to 13% compared to 2021. EPS in the range of 30 to 40 cents. This compares to a same-store sales increase of 31%. I'd have to read that again because you're saying same-store sales to decrease 10%, but this compares to a last first quarter. Sorry, I'm reading too fast and trying to talk at the same time. So here's going to be a problem, certainly for the first quarter. Last year you did 31% increase in sales, and you produced an EPS in that quarter of almost $1. That's going down this year. Now, do they say guidance for fiscal 22? We're assuming no COVID, blah, blah, blah. Outlook for difficult comparisons. Looking beyond the quarter, and this is what you have to dig into when you don't have analyst coverage. While comparisons to the prior year will be challenging, our outlook remains positive, confident in flexibility. Okay, that's probably not going to be taken particularly well in this environment because there's no numbers, right? And they're using a lot of ambiguity when you talk about flexibility of our business, diverse products, blah, blah, blah. People want numbers. I'm not in the stock. I don't necessarily care either way. But it looks like, let's do year to date. That last transcript post that we were looking at was March 1st. Now they went up. I don't know when that came out, but it did go up and it's sustaining here a little bit, so maybe it's not so bad after all. I'm going to do my last SeekingAlpha plug here. Another place that you can dig in It's sort of unseen or not talked about. So whoever this dude is, he wrote an article, which is great. Sometimes I'll read the bullet points of the article, particularly for a stock like this that I'm not like mega interested in. Get the bullet points, blah, 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 then go down to the comments. And there's some gold in here because people will fire back, and it's relatively intelligent comment. So I don't know if this guy's right, but he says, don't believe the buyback story. Share count actually increased about 500,000 from a year ago. This could be stock-based options. This one's too long. I'm not going to read it. DKS sees continued. So there's a comparison to Dick's. I wonder if the short interest figure is out of date. I have no idea. America returns to the outdoors. Kids return to the field. This is kind of what I was thinking with Dick's. You get 420 store chain with no debt, 6% dividend, a stock buyback, and a 34% short position. Sign me up. So I'm not saying that those things are right or wrong. My point is sometimes the best opinions are right in front of you, and that's what, my sales pitch on Seeking Alpha is there's a ton of opinions in there, right? Like you get the people who write the articles, you get your own analysis, and then surprisingly, those stupid comments can lead you down another rabbit hole, right? So that guy was calling out the buyback program and saying it wasn't true. All that information's in Seeking Alpha, so you can go figure out if he's right or not. So anyway, okay, enough pitch for the day. Dividend day is today, Montero says. So it wasn't cut. So I wonder, too, with that dividend day, if we will see maybe a fallout from there. I saw it with Rocket. So Rocket announced $1 special dividend. And it did move the stock price just a little bit with Rocket, but now the ex-dividend date was on March 7th, and it's since lost steam. Not super surprised, but I'll be sticking around to catch that dollar. Anyway, I put enough time in that stock. Sniff's here, and he's going in crypto, and Sniff, I like it too. I really do. Bitcoin only for me. I'm not a big holder at all, but I have over the past couple weeks particularly with the war, I've been throwing about $100 in a week, which is nothing in Bitcoin land. But the case for it is I think it's building. I think the case for it is building, and I think that let me backtrack here. The case for owning some is building. I don't have the same pipe dreams as everyone else does that Bitcoin, I shouldn't say everyone else. Some people think Bitcoin is going to be, the currency of the world and American dollar goes away. I don't believe that at all. But I will say this, with as small as the supply is and as much economic trouble as places like Russia's about to be in, Ukraine, Zimbabwe, if I lived in any of those places, I sure as hell wouldn't be buying the fiat for my country, right? So that's where I think that Bitcoin's worth a reasonable percentage of your portfolio if you haven't bought in yet. I'll do a little video on that this week because I've actually had fun with it, and it's so weird because I don't even care about the days that it's down. I didn't even look today. I'll show you this. I don't think that this is a big top secret site, but it's called, shucks, I have to bring out my little coin market cap. Here we go. I think this is the biggest website. I have no idea. Sniff would probably know, but I look at this site all the time. And you saw there's, here's your last 7 days. That's why I like this site, is because they do this boom, 24 hours, 7 days, circulating supply, last 7 days chart. It's a cool, if you're not deep in it, AKA me, It's a nice way to look at it. It's 100% free. I signed up so that I could do this like watch list thing. And I'm down for the Voyager token, as I've stated before, because you win or get rewards on Bitcoin. So I'll do that. I'll tell you guys what I'm up to. It's literally just a couple grand right now, but that's mostly because I've twice now sold out of Bitcoin. All right, I sold out of, my longest holding was GBTC, Grayscale Bitcoin Trust. I took profits in that sometime during COVID. Can't remember if it was 2020 or 2021 when Bitcoin spiked. I took my money out and got the gain. Then I was over in Webull for 2021 and had some decent gains there. But I sold out of that because I did a test with Voyager and I just like Voyager a lot better. And with Voyager, you can send it, this isn't me, but you can send it to your cold storage or whatever you're really probably supposed to do. Whereas Webull was just trading, it wasn't really Bitcoin, right? It was just like the value and you didn't really own the coin at all. So that's why I made the switch. I thought, well, I mean, Webull is cool. It's a nice site, and they gave me my money and everything else. So kudos to them, but I just went with Voyager for a whole nother reason. All right, Sniff just says, I've had too many gains investing. Hopefully regulations won't see. I think we're good on the regulations game. You know, I don't want to jinx it, but I would say, in general, I'm thinking long-term positive on a lot of stuff. Stocks, economy, travel, even the current war situation, inflation. I think I'm long-term positive across all of them because if you're going to buy anything, if you're going to make an investment, I think you should be buying right now, almost across every single asset class. The only asset class that I would be worried about right now, ironically, would be gas and oil companies, because how much higher does it go? I mean, America will not ever, I don't want to jinx it, but America will not be $10 a gallon in the Midwest. It's just not going to happen. There's too much political pressure. There's too much reserve oil in our world, in the country, to let it go to that level. So painful, very painful, perhaps all the way through, 4th of July. I don't know. But outside of oil, I think you have to think about making a purchase in your favorite asset class. It could be bonds if you're super conservative, because we know interest rates are going up. It could be stocks. I highly recommend big name stocks with an EPS. That's where I'm trying to stick to. And then the other side is crypto. Could be an opportunity there if you know what you're doing and you're comfortable with it. I don't know what's going to happen to housing. I would say, like, my look on housing is I wouldn't be surprised if the prices for houses come down in lockstep with interest rates going up, but I don't see housing crash. I don't see housing prices falling 40%, for example. I see that we are definitely touching the top tier of what most of America can afford. And so when the interest rates go up and they increase the cost of the transaction in total, not to mention the monthly payment, then we will see things come back down just a little bit off of the sale price, so that the rest of the transaction can be affordable. So that's one idiot's take on real estate. All right, guys, I'm going to head out to lunch. I've also got my little youth baseball team's got practice after school today, so I got to do that. I'll come back with a more formal video tomorrow. Hopefully you liked the shares outstanding topic. Let me know if you're watching this on replay. Let me know what you think in the comments. Don't forget to check out the Seeking Alpha affiliate offer. We will see you on the next video. Thanks.